153 on 10s. I know you're looking at the yield curve, Kriti. What do you see?
Yeah, well, one of the big questions that we're ending 2021 on essentially is if we're expecting 3 rate hikes in 2022, why are yields so low relative to that thought process? So that brings me, of course, to the yield curve. I like to look at history for moments like these to see if there's a pattern, John, and that's really what my chart of the day shows here. Essentially, the 2s10s curve going all the way back to 2010, going and really accounting for essentially the last recovery period, this expansion that you've seen. And I want to highlight 3 distinct parts of that historical timeline that I'm really highlighting. First, in 2013, where we talk about the taper tantrum, 2016 with the Trump election, and then, of course, what we are seeing now. And I'm just going to walk you through those. In 2013, the big question was, do we start to see a hike in monetary policy as signaled by Ben Bernanke tapering? We all remember that's really 2013, May 22nd, I believe, his testimony that sent yields higher, the 10 yield higher in particular. And it kind of created this extreme reaction in the Treasury market, which was then turned around and pared back. You saw a similar reaction with the Trump election in 2015, I believe, 2016, excuse me, for the 2017 starting of his term. And you saw this massive kind of risk-on behavior after his election, this massive jump in yield, and then it kind of turned around at the start of his term in 2017. You're seeing a similar thing now because at the end of 2020, that Pfizer Monday, November 9th, when he got that vaccine news, you saw once again this very extreme move in yield that is now getting pared down. So we are kind of racking our minds talking about, well, what is the fundamental reason for some of these yields to be really so suppressed?
I'm racking my mind with all these dates. How many years did you just give us?
I've given you a lot, but there's a lot of history to get through, so I gotta run through them, Matt. But basically, the takeaway here is that we're talking about fundamentals, how much fundamentals are driving the market, but sometimes it's just technical. Sometimes you're just reversing at a very extreme move, and I'm sure John is cringing right now that I mentioned technicals. But right now, for the yield curve, that seems to be what's driving the market.
But Tom Keene is smiling because he loves historical context, Kriti. He likes to take charts as far back as they go, so you're doing the right thing. At the same time, when we talk about a flatter yield curve, in theory, that's not great for the banks. Yet we've seen a persistently flattened curve, and the financials are up 33% this year, one of the best performing groups in the S&P 500.
They really are, and that's really where you see that kind of massive disconnect, the macro disconnect, because a lot of folks have been saying, well, the stock market is taking their cue from the bond market, and they were earlier in the year, and now you're starting to see that dispersion. The question here is that if the bond market, let's say even on a fundamental basis, is perhaps pricing in slower economic growth in 2022, or perhaps the effect of the Omicron variant as shown by the curve flattening, well, the stock market is still hitting record high after record high. So that isn't something that's just isolated to financials where you're seeing that divergence. You are seeing this in the broader market as well.
Is this all built off of 2022 earnings expectations, Kriti?
The stock market, it kind of seems like it is, in addition to operating margins, which have also, if you're starting to look at how much operating margins are their prediction in 2022, the idea, the consensus seems to be that those margins will continue, that a lot of these companies will still be able to pass on those essentially higher costs onto their consumers, which is interesting because that's not what the bond market is saying. The bond market is saying that inflation is still going to be a problem in 2022.